Hey friends, welcome back to the Investing Iguana. I'm Iggy, and for those who are new here, I've been covering everything about Singapore stocks, finance, CPF strategies, and smart investing for years. The Investing Iguana channel was ranked 8th in the 2024 Influential Tigers by Tiger Brokers, and just last month, we crossed the 1 million mark for total reads and hit a massive 58,000 likes. With over 900 videos and 500,000 watch hours by June 2025, you can count on us for credible, in-depth analysis with a Singaporean touch. Today, we're diving into a crucial update. Mapletree Logistics Trust's Q1 results for financial year 25-26. If you want to know what these numbers really mean for your portfolio, stick around as we break down their report slide by slide. So, what are we looking at in this latest quarterly update? Here are the key questions we'll answer together. How did Mapletree Logistics Trust, or MLT, perform during the last quarter? What's driving the changes in revenue and distributions? Are there red flags or hidden opportunities for Singapore investors? And most of all, should you buy, hold, or sell this REIT right now? All right, let's start with their key highlights for Q1, ending June 2025. It's impossible to ignore the headline. The distribution per unit, also called DPU, tumbled by 12.4% year on year, landing at 1.812 cents. If you're collecting dividends from MLT, that means your payout just shrank significantly compared to last year. But it's not all doom and gloom. Gross revenue came in at 177.4 million Singapore dollars, down by 2.4% from a year ago. Portfolio occupancy held up at 95.7%, which means the vast majority of their warehouses and logistics facilities are still fully leased. What caused the dip? The culprit was weaker regional currencies hitting the value of overseas rental income and the loss of revenue from 12 properties that were sold in the past year. Management also pointed out that on a constant currency basis, the drop in operational performance would have been far smaller, so the underlying assets remain solid. Next, let's talk about MLT's finances and capital management. Their net property income, the money left after property expenses, was $153.4 million, down 2.1% year on year. Distributable income to unit holders came in at $92 million, 11.3% less than last year. Borrowing costs increased to $39.4 million, up 2.3%, mainly because of higher rates on replacement hedges and new loans needed for expansion projects, especially the new Joo Koon logistics hub in Singapore. Aggregate leverage, which measures how much the trust depends on debt, rose slightly to 41.2%, but this is still safely below the regulatory limit of 50%. About 84% of MLT's debt has already been locked in at fixed rates, insulating them from large rate shocks. That's a smart move in today's environment and offers some peace of mind to investors. Now let's put these numbers into context for Singapore investors. Despite a headline-grabbing drop in distribution, MLT's fundamentals remain resilient. The trust drew 85% of its revenue from tenants serving domestic consumption, with only 15% coming from export-related tenants. That means even when global trade is shaky, the bulk of their tenant base is focused on serving local and regional needs. What about overseas exposure? The portfolio is diversified, with significant revenue from Singapore, almost 29%, with other key markets being Hong Kong, China, and Japan. Singapore actually contributed more this quarter due to stable demand, while China and some regional markets struggled. In practice, it's like running a chain of shops across different neighborhoods. If one area is down, others can help keep the business strong. Let's talk about operational metrics. Portfolio occupancy stayed strong at 95.7%, and excluding the low occupancy new asset in Joo Koon, Singapore's occupancy rate climbed to 96.4%. That's an encouraging sign for our local market. For comparison, Japan still boasts above 99% occupancy, and Australia and Vietnam are at full occupancy, showing reliable demand for high-quality logistics space in these markets. China is the main headache, with occupancy above 93%, but negative rental reversions at minus 7.5%. In plain English, leases were renewed at lower rates this quarter. Still, that's an improvement from last quarter's minus 9.4%, hinting that things could be turning around, even if it's slow. What's MLT doing to stay competitive? On the portfolio front, management is not afraid to recycle capital. In the past 12 months, they sold off 12 older assets, using the proceeds to invest in higher-yielding, modern properties. Their redevelopment project in Jukun transformed a 2-story industrial building into a 6-story modern logistics hub, costing $205 million and increasing the total floor area more than twofold. In Malaysia, they're seeking to combine 2 land parcels to create a mega, modern ramp-up logistics facility. These moves aren't just flashy. They boost potential rental income and keep the portfolio attractive to quality tenants. Sustainability is another theme this quarter. MLT ramped up its green initiatives, increasing self-funded solar capacity by 31% to 47.5 megawatts and getting green certification for more than half of its properties. The trust has a target to hit 100 megawatts of solar by 2030 and certify over 80% of its assets as green buildings. They also secured $365 million in new green and sustainable financing, which now makes up around a quarter of their total borrowings. For investors, this means MLT is positioning itself for the growing demand for environmentally friendly logistics space, which can command premium rents and appeal to multinational tenants. Let's pause here for a quick call to action. If you want even more detailed breakdowns with deeper dives into the financial figures, extended models, and my full written commentary, be sure to check out the Investing Iguana Substack. You'll find the link right in the description. On Substack, I post detailed analysis and extra data for premium members that you won't see here on YouTube. Back to the outlook. The economic environment remains challenging. Management was up front. They expect continued pressure from higher borrowing costs and regional currency weakness. They're watching the global economy closely, especially the US and China, as trade uncertainty and currency swings could affect both tenant demand and asset values. However, the management team is taking a disciplined approach, focusing on keeping portfolio occupancy healthy, managing costs tightly, and using hedging strategies to buffer against market swings. They're also committed to the long-term strategy of recycling capital from older assets to modern new ones, which positions MLT to ride out the current storm and bounce back when conditions improve. So, how does all this affect you as a Singapore investor? Let me give you my assessment. MLT remains a high-quality REIT with solid sponsors and good management. Their properties are broadly diversified across Asia Pacific, offering you some protection if any single market faces headwinds. The current dividend yield is above 7%, which is attractive for income-focused investors, particularly those using CPF for steady, long-term returns. The headwinds in China and the potential for continued currency weakness are real risks, but the trust is managing them actively. My view? If you're looking for a stable, income-generating REIT to hold for regular distributions, MLT is still a good option. But if you're hunting for quick capital gains, you might want to wait until the external environment improves and DPU growth picks up again. Overall, I see MLT as a hold. The trust's fundamentals and management approach make it a solid pick for long-term, income-oriented Singapore investors, but don't expect miracles in the next few quarters. Consider it for the stable distributions to your CPF or SRS account, and as a core holding in a diversified REIT portfolio. We've just dissected Mapletree Logistics Trust's latest report, and I hope this helped you understand what these numbers mean for your investments. If you found this video useful, give it a thumbs up, share it with your friends, and subscribe to the Investing Iguana so you never miss our next insights. For those who want to get truly ahead of the pack, our premium members enjoy early access to all our videos, sometimes a whole week before anyone else. That means you get my analyses and hot takes on major market moves straight to your inbox before the rest of the crowd. It's just $1 a month, much less than your morning copy. You'll get a daily scoop of financial wisdom and a head start on big investing moves. Ready to join the inner circle? The link to become a premium member is in the description below. Thanks for watching. If you want to learn more about how REITs can defend your portfolio against inflation, check out our previous deep dive on Singapore REITs and inflation protection, where I explain which local trusts may keep your purchasing power strong as prices rise. Until next time, stay curious, invest smart, and take care.